Hello friends, welcome back to my channel. This is Kingsley and in today's episode I'm going to explain some basic details of mutual funds, how it works, what are the types of mutual funds, why mutual fund is also a good investment for future. So please watch the full video and don't skip in between or else you might miss some important points. Come, let's get started. What is mutual funds and how it works? To answer this question, I would like to start off with two different examples. First, let's say you have a bike and all of a sudden your bike is not working. You're trying to find out the problem, but still you're not able to figure it out. So now what you will do? You will search and find a nearby reliable mechanic and you will ask him to rectify your bike problem. And now this person will figure out the problem and he repairs your bike and he return it to you with perfect condition. For that, he will charge some amount. So you're paying that amount and now you're having a happy ride. Similar example applies to mutual funds as well. Here, how it works is there will be a group of people who invest their money in some mutual fund companies, and there will be a fund manager or financial expert who governs that particular mutual funds and your money. Now, this fund manager will diversify your money into different mutual fund schemes by investing it in like equity funds, debt funds, hybrid funds like that. By the diversification, this person generate profit through the money you invested. So now, once he attain profits, this person return your money with some good rate of interest. In a simple term, this is how it works. I hope you have some understanding now. Example 2 is there are two types of people. One is category A people who are high risk takers. They have an aspiration to research well and invest their money by themselves. They do their own research before investing in stocks, bonds, and golds like that. So they are called investors. Next is category B people who are afraid to take high risk. They wouldn't be interested to research and invest, or they'll merely say they don't have time for it. So they seek some financial advisor support to get some good returns rather than investing in FDs and RDs. So this financial expert collect the money from category B type people and through his fundamental analysis, he will invest that money into different mutual fund schemes to look for a lucrative income. Once he gain profit, he will return it to the people with some good rate of interest. So mutual fund is the right platform for category B type people. I hope you got some basic understanding of mutual funds now. What are the types of mutual funds are there? So there are so many mutual funds out there, but as per SEBI's governance, they restricted it to five types. First is equity funds. Here, the fund manager invests your money only in equity shares like large cap, mid cap, and small cap funds. If you're a person who's ready to take above an average level risk, and if you're expecting a high returns on your investments, then equity mutual fund is the right platform for you. But before you select the fund, check its past performance and its yearly interest return rates. And the second is debt funds. Here, the mutual fund manager invests your money into debt instruments. It's typically a low risk fund, hence its yearly returns also will be low. And the third is hybrid fund. Here, the fund manager invests your money in both equities and debt mutual funds. So there will be a both side balance on the money you invested. Investing in this fund is like a kind of average risk and average returns. And the fourth is solution oriented funds. Here, the fund is typically planning for our future goals, like our kids' future education or their marriage plans or for our pension, like that. This is something you can plan and invest your money from their early age itself. When we predict some future financial crisis, this mutual fund investment would definitely give a solution for it. Hence, it is called solution oriented fund. And the fifth is others. As I told you earlier, there are so many mutual fund schemes out there. Whatever the new mutual fund schemes comes in, it falls under mutual fund, other mutual fund category, like tax saving mutual funds and index mutual funds like that. So let's take this index funds. How it works here is the fund manager invests your money directly into Nifty and Sensex. So over the years, when Nifty and Sensex points increase, automatically your money will appreciate and it will grow, and it gives you an excellent returns. On the flip side, if the Nifty and Sensex points goes down after you invested, then again your money also will come down. What are the details to check before investing in mutual funds? Firstly, we should have a clear roadmap of our investment target. Before investing in any mutual funds, we need to have a proper calculation of how many years we gonna invest and what would be the risk reward ratio for that. I mean, what's the return of interest we gonna get through our investment? If someone selects like debt funds, its risk reward ratio is low and the returns are also going to be low because it gives average of 7% return per year. Likewise, liquid funds are there, low duration funds are there, short term and mid term funds are there, gilt funds are there, where this gilt funds manager, they used to invest your money only in government bonds. In equity funds are also like there are small cap, mid cap, and large cap funds are there, which operates as per market condition. If the stock market is going good, definitely it will provide good returns as an average of 15% per year. And if the market goes down, obviously it will give low return. Before we select any mutual funds, we need to do a short research about that mutual fund company. We need to check the fund manager profile because this fund manager is the one who is gonna handle and diversify our money into different sectors. So all those details are very transparent and available in the sites like moneycontrol.com. Lastly, we need to check their brokerage expense ratio as well, whether they're charging 1% or 2% or 3%. If they charge 1%, it's benefit for us only. What are the basic slabs to invest in mutual funds? Basic price to start investing in mutual fund is from 500 rupees to the max what you can. There are two types of investment plans available here. One is systematic investment plan or SIP and the other is lump sum method. You can also select an auto debit option if you have enough cash in the bank account. If we select the date with number of years, your money will automatically debit on that particular date. Once we started investing money in mutual funds on a monthly basis, as per the process, it will take 2 to 3 working days to reflect in your portfolio. Simultaneously, we will also get a mail confirmation from the mutual fund company for the amount we invested, and they will allocate a folio number for which is a proof of document for the amount we invested. What are the mutual fund websites and mobile applications are there? So many mutual fund websites and mobile applications are there. Before you invest, review those websites, and if you think it's reliable, then you can start investing through those platforms. Some famous websites like SBI Mutual Fund, ICICI Mutual Fund, Grow mobile application is there, Funds India, ET Money Mutual Fund application is there. So likewise, we have so many mutual fund applications are there. So before you investing in through those mutual funds, just check their expense ratio. As I told earlier, just check how much are they doing a brokerage fees of like 1% or 2% or 3% like that. And finally, you may ask me, is it safe to invest in mutual funds or not? My answer is it depends on how many years you invest in mutual funds. Let's say if your investment period is between 5 to 10 or 15 years, then definitely your money will appreciate and you will get an excellent return. I wouldn't say it's a big risk to invest in mutual funds. It generally works as per market condition. In a nutshell, high risk, high rewards, low risk, low rewards. So that's about it. Power of compounding using SIP calculator. Let's quickly calculate return on your SIP investment. So I'm already here in SAP calculator.in. Let's say on a monthly basis, you're going to invest 3000 rupees and the investment period is for 5 years and the expected return is somewhere around 14%. And adjust for inflation? No, I'm not giving the adjust for inflation at this point of time. Let's say I'm just giving the calculation. Here it's showing the expected amount is 2.6 lakhs and the amount we invest would be 1.8 lakhs and the wealth gain is 81,602. Here the pie chart clearly indicates amount invested is 1,80,000 and the wealth gain is 81,602 rupees. Let's say we're going to invest 5,000 rupees for same 5 years and a minimal average return of 14% per year. I'm just calculating it. Now it's giving the amount invested would be 3 lakhs and the wealth gain would be 1.4 lakhs. Here it is 3 lakhs we invested and 1 lakh 36,000 we are gaining through that as a return on interest. Let's say same 5,000 and we are going to invest for 10 years and the average return percentage is 14. I'm just calculating here again. So the amount we invested would be 6 lakhs and the wealth gain would be 7 lakh 10,000 rupees. I mean 7.1 lakhs. So the total maturity amount will be 13 lakh 10,457 rupees. Let's say the same 5,000 rupees we are going to invest for 15 years. I'm just calculating and the same 14% average I'm giving here. Alright, so through the calculation, the amount we invested would be 9 lakhs, but the wealth we are going to gain through that investment is 21 lakhs, 21.6 lakhs exactly. So the pie chart clearly indicates 9 lakhs we invested for 15 years and the wealth we are gaining is 21 lakhs. Let's see another one example. Same 5,000 rupees on a monthly basis we are going to invest for 20 years. Same 14% average return and I'm not giving inflation ratio here. I'm just calculating it. So the amount for 20 years, 5,000 rupees on a monthly basis, the total amount would be 12 lakhs and the wealth we are gaining through that is 53.8 lakhs, which is outstanding, right? And the total maturity amount will be 65 lakhs 81,731 rupees. Okay, so this is called power of compounding, and this is what this is how the investors they used to think, and this is the main reason why I'm saying we need to go with a long-term investment in mutual funds. Thanks for watching. If you think this video is useful to you, just give it a thumbs up and share it to your friends and family people. I see you all with another interesting video shortly. Till then, this is Kingsley signing off. Stay tuned. Bye bye.